Today's video, we are going to be talking about gold. We are going to look at a couple of the ETFs. Now, this is designed to provide investors with a cost-effective way to conveniently gain exposure to the price of gold bullion. We're going to look at some technical analysis to see if we're interested and when would be a good time to buy into this. I appreciate and respect your time, so let's get right into the video. We're going to look at GLD, IAU, and the GLDM. If we look at the GLD, this is the Spider State Street Gold Advisors established in 2004. Their current expense ratio is 0.40%, and they have a market cap of $97.68 billion. Now, when we look at the IAU, we have a 0.25% expense ratio, so it's going to cost you a little bit less, and there's 45 billion in change in assets. Then we also have the GLDM Spiders. This is the mini shares ETF. This one was established in 2018 with the lowest expense ratio of 0.10. Currently has 14 billion in assets. And as you can see, this is a 5-year chart. We're going to get a little more granular, and we're going to look into some of the candlestick charting with moving averages. This will give us a better, more detailed analysis on when to get into the stock versus this right here. This looks like it consolidated for a few years, and it's been off to the races here in the past couple of years. But we're going to get a little more detailed with our information in that. GLD, we have a 52-week high of 317, a 52-week low of 210. The IAU was 64. With a 52-week low of 43, and the GLDM with a 52-week high of 68 and a 52-week low of 45 and change. All of the performances are going to mirror each other with the exception of the expense ratio. So depending on how much money you plan on putting into this, and if you're going to be investing in this for a long period of time and dollar cost average into this thing, well, that expense ratio does add up over time. Now we are going to take a look at the price versus the 10-day, the 50-day, the 100-day, and the 200-day moving average. As you can see with the 200-day moving average, 17% range. The 100-day moving average was 11%. The 50-day moving average is 4%. And the price versus the 10-day moving average is negative 2.97%. And this will show up when we get into a more detailed chart. First on deck is the GLD. Let's take a look at the GLD. This is going to take us back 20 years to 2005. As you can see, the low was $41. Its current high is 317. So if you put your money in there for the past 20 years, you would have done very well. But here's the challenge that you're going to have. You had 1, 2, 3, here's a downdraft, and then 1, 2, 3 years of an updraft, a downdraft, and then you have 3 years of an updraft, consolidates for 2 years, and then there's a downdraft for a year, and then gold consolidates for another 1, 2, 3, 4, 5, 6 years. We go into an updraft, we're into a downdraft, a consolidation period, and then breaks out in 2024. So the big challenge that you're going to have with this, if you come back to this area right here, when gold peaked out in 2011, in this particular ETF, which represents the actual gold bullion, this peaked out at a high of 185.85. Now the whole gold sector went into a consolidation period, pulls back, consolidates for several years. It goes into a bullish phase for 2 years. From back here in 2011, we have 1, 2, 3, 4, 5, 6, 7, 8, 9 years later, we're at the break-even point. So if you would have invested in the gold industry in 2011, you would have been upside down. You would have been in a losing position with your money for all those years. Now, you could have invested that in something else and made money and made dividends and doubled your money. If you invest, go by the rule of 72. If you invest into a product at a 10% annual rate of return, your money's going to double every 7.2 years. It's a 5-year weekly chart of the GLD. Just for fun, we're going to take a look at the IAU, and we will see it's basically the same thing because it represents gold. You're buying gold bullion through the ETF. This way you don't have to actually hold the physical gold in your house or pay for a security box at the bank. This way here you can get in and out of your position with gold with the click of a button. But some people like to actually hold the physical asset and insure it and protect it and dust it and hide it. And not me, I'll trade this if I'm going to trade this. I used to trade gold years ago, trading the assets, but as far as investing in gold, too much of a slow coach for me. If you would have invested that in something else, in the S&P 500, you're buying 500 companies. The average of the S&P is 10%, 10 to 12%, depending on dividends. If you count in the dividends, if you're at a 10 to 12% range in the stock market, your money's going to double every 7.2 years. That's the rule of 72. Your money will double every 7.2 years. So whatever you would have invested in 2011 in gold, 7 years later, if you were in gold, you were in a losing position. If you were in the S&P 500, you would have doubled your money. Money from 2011 all the way until March of 2024, you would have been either at break even or in a losing position. That's a lot of years for your money not to be working for you. I'm not a big fan of investing in gold. A lot of people are. This is the GLDM. GLDM launched on June 25th of 2018. Here we go. We had a low of 23.47, reached a high of 68.23. So your difference is going to be in the expense ratios. They're all going to give you the same value. They're going to have a different price on the ETF, but it's still the same value as far as your percentage and relative to the price of the gold bullion. Come back out of here. We're going to go back to the GLD. This is a 5-year weekly chart. So if we're just looking at this for the last 5 years, if we come back to this area here, we reached a high in this ETF, the GLD, of 194.45. Basically went into a downdraft, consolidated. We would have essentially broke even in 2022. Then we went back into a downdraft, consolidated back into the same range in 2023. Now, gold broke out of its range in March of 2024. This would have been an interesting time to get in if you wanted to ride the wave. From March of 2024, gold broke out of its range, and we've been in a bull phase. And in this particular ETF, let's take a look. The actual high was established at 317.63. It reached a high on April 22nd, 2025. This move in the past year in this ETF was from 210 to 317. That's a pretty substantial move. Where would be a good spot if you really wanted to, you just had your heart set on, I want to buy gold for the next 10, 20 years based on the history? That's the kind of results that you're going to get. We've already had a big move in gold. Can it go a lot higher? It certainly can. But if I was going to buy this, I would look at the moving averages. The black is the 10, the purple is the 21-day, the green is the 50-day, and the red is the 200-day moving average. You're looking to buy into this. As you can see, gold traded down to the 50-day. Back in this range, you can see the moving averages were all in alignment with each other. You could have bought at the 10, 21, and the 50-day. It's been riding the 10 and the 21-day, but it tends to breach it and breach the 50-day also, and we went into a consolidation period. It looked like back here, it looked like it was trying to push into the 50-day moving average, which would have been April 7th. So if I'm going to buy into gold, I would buy into this ETF. I would look into this range right here, 281.48. We are currently at 298.24, and gold is currently in a downdraft from the all-time high. I would give this a little more time. You can use the GLD on a 1-year time frame. Set your moving averages. Your 10 is the black line, the 21 is the purple line, the green line is the 50, and the red line is the 200-day moving average. These are standard moving averages. Many of the hedge funds, institutions, banks, money managers use these as standard benchmarks. That's why you will actually see a lot of charts will ride these different waves. In a bull market, you will see a stock or an ETF will ride the 10 and the 21-day moving average, and it will occasionally breach it and hit the 50 and bounce off of it. That's going to be in a bull market. Now, when we get into a consolidation period, or if we go into a bear phase, it will breach the 10, 21, 50, 100, and it will go down and test the 200-day moving average. Now, I don't know if that's going to happen anytime with gold soon, but if you wanted to trade it, I would look at the 50-day moving average. You're looking at 284.48. I hope this was helpful. If you found it helpful, subscribe to the channel. Appreciate the support. Always remember the market's very risky. Do your own due diligence. God bless and happy investing.